Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at IREN.
And if you find our talks useful, please consider subscribing, like, and comment underneath. It really helps us out.
It really does.
Okay, so I want you to picture a company that is, it's kind of living a double life right now.
A double life. I like that.
Yeah, because on the surface, if you just, glance at the headlines from earlier this month, it looks like a disaster zone.
Total disaster zone.
Revenue is down, there's this massive net loss on the books, and the stock price, well, it took a double-digit nosedive.
It did.
But then if you stop reading the headlines and you actually open up the financial statements, you see something completely different. You see a company sitting on billions in cash.
Right.
With one of the biggest tech companies in the world paying for its new gear up front.
It's a classic case of market cognitive dissonance. We are talking about IREN today, and it is, I think, one of the most misunderstood stocks I've analyzed this year.
It's misunderstood. How so?
Well, it's caught in this really messy, noisy transition phase between being a Bitcoin miner and becoming an AI hyperscaler.
Right.
And because the market just hates uncertainty, the stock is volatile. But for the people who are actually paying attention, to the mechanics of the deal they just signed, that noise, it looks a lot less like a warning sign and a lot more like an opportunity.
Okay, so let's cut through that noise. We're recording this on Tuesday, February 17th, 2026.
Yeah.
A couple weeks ago, February 5th, IREN dropped their Q2 earnings.
They did.
And to put it mildly, the market did not throw a party. The stock dropped somewhere between, 11 and 14% almost immediately.
It was a rough reaction. And look, if you only glance at the top line numbers, you can understand why people panic sold.
I mean, they look bad.
They do. Total revenue dropped to $184.7 million. That is down significantly from the previous quarter where they did over $240 million. And then the kicker, they posted a net loss of over $155 million. Yeah. If you are an algorithm just reading that news release, or you're a casual trader, you see revenue down, massive loss, and you just hit sell.
Right, and that's the instinct. But we need to unpack why those numbers looked that way. Because this isn't a case of a business failing, is it?
No, not at all. This is where you have to remember that IREN is still, for now at least, tethered to Bitcoin.
Okay.
The main driver for that revenue drop was the Bitcoin mining side of the business. Their mining revenue fell to $167.4 million. And you have to put this in context with what just happened in the crypto market.
That crash we saw.
Exactly. Bitcoin prices crashed from those, euphoric highs of $96,000 all the way down to around $66,000.
Which was a brutal correction for anyone holding the actual coin.
Absolutely. But it gets even worse for miners. At the same time the price dropped, mining difficulty went up.
So it's a double whammy.
A perfect storm. You have an asset that is worth less, and it is chemically harder and more expensive to produce that asset. Yeah. That is a mathematical guarantee that your revenue is going to take a hit. So that explains the revenue dip. It's cyclical, not structural.
Okay, that makes sense. So the crypto winter, or maybe a crypto chilly spell, explains the revenue drop. But I want to push you on this $155 million net loss. You can't just blame Bitcoin prices for a loss that big.
Right.
That sounds like a company that is just bleeding cash. Is this a burn rate issue?
This is the most important part of the report to understand, and it's where most people get it wrong. That $155 million loss, it's almost entirely non-cash.
It's an accounting thing.
It's pure accounting.
Okay, so break that down for me. How do you lose $155 million without actually, losing money?
It comes down to two main things. Unrealized losses on the Bitcoin they're holding on their balance sheet and something called impairments on their hardware. Let's focus on the impairments because that's the real signal here. They took a massive write-down. We're talking over $30 million in impairments, plus nearly $220 million in unrealized losses because they are retiring old hardware.
This is the switching costs you were talking about.
Think of it like this. Imagine you run a taxi company, right? And you decide the future isn't taxis, it's Formula One racing.
A little bit of a jump.
A big jump. You have a fleet of old sedans. To become a racing team, you have to get rid of those sedans. You can't use them. So on your books, you have to write down the value of those cars to zero, or you sell them for scrap.
Right.
On paper, your accountant says, hey, we lost millions on these cars. But in reality, you didn't write a check for that loss. You just admitted the old assets aren't part of the future. You're clearing the deck for the new race cars.
So the loss is basically them admitting that their old Bitcoin mining rigs, the ASICs, are not useful for the new business model. which is AI.
Precisely. Unlike a GPU, which is super flexible, you can use it to mine crypto, render a movie, train a language model, and ASIC is an application-specific integrated circuit. It does one thing.
Mine Bitcoin.
Just mine Bitcoin. So if you want to pivot to AI, those machines are basically expensive paperweights. IREN is taking the financial hit now to clean up its balance sheet so it can fill those data centers with brand new GPUs. It's a sign of conviction, not failure.
Okay, that makes the loss much more palatable. It's a renovation cost. But let's talk about what they're renovating for. You mentioned this double life. If the miner side is shrinking, what is the AI side doing?
Now we get to the good part.
Because AI pivot is a buzzword every company is throwing around right now to pump their stock. Is there any actual meat on the bone here?
There is a lot of meat. While everyone was wringing their hands over that mining revenue drop, IREN's AI cloud revenue was up 541% year over year.
Hold on. 541%. That's easy to do if you started with, $10 and now you have 50. Is this meaningful revenue?
It's becoming meaningful very, very fast, but the backward-looking growth isn't even the main story here. It's the forward-looking contract that changes everything.
The Microsoft deal.
We have to talk about the Microsoft deal, the $9.7 billion number.
It's a huge number.
It is, but I want to look past the headline number and really dig into the structure because this is so rare. IREN has a target to reach $3.4 billion in annual recurring revenue, or ARR, by the end of this year, 2026.
Okay.
To do that, they need to deploy 140,000 GPUs.
140,000 GPUs. I just want to pause on the scale of that for a second. That is incredibly expensive. Usually when a company says, we're going to buy 140,000 chips, my immediate thought as an investor is, great, how much are you going to dilute me to pay for it?
Or how much debt are they taking on?
Exactly, because NVIDIA chips are not cheap.
Well, that's the standard playbook. You issue shares, you dilute your investors, you buy the chips, and you just hope you can lease them out. IREN completely flipped that model on its head.
How so?
Microsoft didn't just sign a contract to pay them later. Microsoft prepaid them $1.9 billion.
Wait, they handed them nearly $2 billion in cash up front, before the chips were even online.
Yes, and that is the detail that de-risks this entire trade. That $1.9 billion prepayment covers roughly 95% of the capital expenditure needed to buy all those GPUs.
So Microsoft is effectively financing IREN's entire expansion into AI.
They are.
But why would Microsoft do that? I mean, they aren't a bank. They usually squeeze their vendors, not bankroll them.
It tells you everything you need to know about the state of the AI market right now.
Yeah.
Microsoft is desperate for compute. They are so supply constrained that they are willing to act as the financier just to guarantee they have a place to plug in their models.
And for IREN shareholders.
For IREN shareholders, this is the holy grail. You get all the growth of a massive tech expansion, but you don't get the dilution that usually comes with it.
That changes the risk profile completely. It's not a speculative gamble on if they can afford the chips. The chips are already paid for.
They're paid for.
But this leads me to what I think is the even bigger bottleneck right now. It's not chips, it's power. You can have the chips, you can have the cash, but if you don't have the power, you've got nothing.
It's the biggest bottleneck by far.
And we keep hearing that the U.S. power grid is just tapped out.
It is, and this is where the story shifts from tech to infrastructure. In 2026, chips are becoming a commodity. You can buy them if you have the cash. But power, specifically grid-connected high-voltage power at a gigawatt scale, that is incredibly scarce.
You can't just go to Oklahoma and plug a data center into a wall outlet.
No, you're talking about substations, transmission lines. I mean, the lead times for high-voltage transformers right now are, what, 3 or 4 years?
It's insane.
It is. So if you wanted to start a new data center company today, you are looking at 2029 or 2030 before you can even turn the lights on, just because of the queue to get connected to the grid. IREN, they've already secured over 4.5 gigawatts of capacity.
4.5 gigawatts. Put that in context for us.
It's massive. A typical nuclear power plant produces about 1 gigawatt. So IREN effectively has the rights to the output of 4.5 nuclear power plants. They've got a new 1.6 gigawatt campus coming online in Oklahoma. This is their moat. It's not the chips, it's the plug.
So they sort of accidentally built the perfect trap. They spent years securing all this power for Bitcoin mining, which everyone thought was this niche, weird industry.
And now that power is the most valuable resource on the planet for AI.
It's the accidental genius of the Bitcoin miner pivot.
It really is. They secured the land and the power contracts when nobody else wanted them. Now, the hyperscalers, Microsoft, Google, Amazon, They're all knocking on their door because IREN is one of the few places where you can actually plug in 140,000 GPUs today, not 5 years from now.
And their competitors.
The other HPC providers, the high-performance computing guys, they might have the software, but they just don't have the juice.
Okay, so let's summarize this thesis. We have a company transitioning from mining to AI. The ugly earnings were just accounting cleanup.
A renovation cost.
Microsoft is paying for all the new hardware up front. And they own the one thing nobody else can get, which is the power supply. So why is the stock at $36.52? Why isn't it at $100 already?
Because of the identity crisis. The market is still treating it like a Bitcoin stock. When Bitcoin dropped from 96K to 66K, IREN dropped in sympathy.
So it's guilt by association. The algorithms that trade these stocks still have IREN in the crypto bucket.
Completely. It's just a correlation trade. But that mismatch, that's the opportunity. And there's a catalyst coming up in just a few days that might force the market to finally wake up.
Okay.
February 27th, 2026.
What happens on February 27th?
IREN is being added to the MSCI USA index.
Okay, for the listener who isn't a portfolio manager, explain why being added to a list matters. Does it actually change the fundamental value of the company?
It doesn't change the fundamentals, no, but it changes the flows. The MSCI USA index is tracked by trillions of dollars in passive funds.
ETFs, pension funds.
Exactly. And these funds have very strict mandates. If a stock is in the index, they must own it. They don't have a choice.
So they can't look at the chart and say, oh, Bitcoin's down today, maybe I'll wait.
No, they have to buy. So on or around February 27th, you're going to see this wave of what we call forced buying. It's purely mechanical.
What does that do for the stock?
It brings a level of institutional ownership and stability that the stock just hasn't had before. It forces the stock out of the hands of, day trading crypto enthusiasts and into the hands of long-term institutional holders.
That sounds like a major tailwind. But I have to play the skeptic here. We've painted a very rosy picture. Free money from Microsoft, unlimited power, forced buying. What goes wrong? What's the bear case?
There are two big ones. Execution and correlation. First, correlation. As long as IREN is perceived as a miner, if Bitcoin crashes to, say, $40,000, IREN stock is going to get hammered.
It doesn't matter how good the AI deal is.
Doesn't matter. The market sentiment will just drag it down. You have to be willing to stomach that crypto volatility.
Okay, and the execution risk.
Deploying 140,000 GPUs is not like plugging in a toaster. It's a massive logistical challenge. You have cooling, cabling, software integration. If they miss their deadlines, if that $3.4 billion ARR target slips from 2026 into 2027, Wall Street will punish them.
The market is pricing in perfection.
Yes. The market is pricing in perfection on this Microsoft deal. Any delay in getting those Oklahoma data centers fully online will be viewed very, very negatively.
So even with the money, they still have to actually build the thing on time.
Right. And while Microsoft paying upfront is amazing, it also puts a ton of pressure on them. Microsoft expects those chips to be online and working. You do not want to disappoint a partner that size.
That's a fair assessment, high stakes. But let's zoom out for a second. The stock's at $36, largely because of this crypto connection. If they execute, if they get these chips online and hit that $3.4 billion revenue target, does the market finally stop calling them a miner?
That is the ultimate question, isn't it? Right now, IREN trades at a miner multiple, which is usually pretty low because mining is a commodity business. But AI data center utilities, companies that provide the core infrastructure for AI, they trade at massive multiples, 20x, 30x earnings.
So the real bet isn't just that they make more money. It's that the market changes how it values the money they make.
Exactly. It is a re-rating trade. If IREN hits that target, they stop being a miner, they become a tech infrastructure utility, and if the market starts valuing them like a data center, the stock doesn't just go up because earnings go up, it goes up because the multiplier on those earnings goes up.
That's where you get the multi-bagger potential.
That's it. You're betting on a complete identity shift.
It reminds me of when Amazon stopped being looked at as just an online bookstore and started being valued as AWS and a logistics powerhouse. The whole valuation model changed.
That is a perfect analogy. And just like with Amazon, the infrastructure, the warehouses, or in this case, the power grid, was the unsexy part that ended up being the most valuable moat.
So for the listener sitting on the sidelines looking at that 14% drop from a couple weeks ago and feeling nervous, what is the key takeaway?
The takeaway is to look under the hood. Don't let the headline loss of $155 million scare you off without understanding that it was a strategic accounting move. Don't let the Bitcoin volatility distract you from the fact that Microsoft has already prepaid for the future.
It's a transition story. And transitions are always messy.
They are, but the mess is what provides the entry price. If this was already obvious to everyone, if everyone already saw them as an AI giant, the stock would be $150, not $36.
That is a fascinating place to leave it, betting on the mess before it gets cleaned up.
And I'll leave you with one final thought. The market is completely obsessed with chips right now, NVIDIA, AMD, but chips are getting faster and they're getting cheaper. Power, on the other hand, is getting scarcer and more expensive. So in 5 years, will the most valuable company be the one who makes the chip or the one who owns the only socket where you can plug it in? IREN is betting the entire house on the socket.
A provocative thought indeed. The landlord might just end up making more than the tenant. Thank you so much for breaking this down today.
Always a pleasure.
And thank you for listening. We'll see you next time.